Imagine this. You wake up and your bank already knows you're late on a bill before you do. Your investment app nudges you to buy a tiny stake in a company because its AI just detected a supply chain twist from satellite photos. Stock markets blink and trade themselves in milliseconds. Entire financial institutions run routine operations without a human in the loop. This is not a sci-fi fever dream. This is now, and it's moving faster than most boardrooms can react. Today, we begin a deep, thrilling descent into the 10 levels of AI in global finance. But first, the primer. AI isn't one thing. It's a ladder. Each rung gives machines more decision-making power, and each climb changes who controls money, risk, and opportunity. By the end of this first half, you'll see how everyday conveniences like chatbots are the quiet foundations for far bigger transformations. The ones that will redraw markets, rewrite job descriptions, and redefine trust itself. Level 1. Banking chatbots, the front door of financial AI. The first, deceptively harmless step is the chatbot, the smiling, endlessly patient digital agent that answers your questions at 3 a.m. These are not the clumsy menus of 2 decades ago. Today's banking chatbots use natural language understanding, context history, and behavioral data to do real work, verify identity, process payments, freeze stolen cards, and even nudge you toward better saving habits. Here's the kicker. Chatbots are teaching your bank how you think. Every interaction becomes training data. Every frustrated customer message becomes a lesson in empathy for the model. Big retail banks report chatbots now handle over 60% of routine inquiries, and some, like Bank of America's Erica, process more than 1.5 million interactions daily. That's not just efficiency, it's an emergent memory layer for the institution. Why it matters? The chatbot stage builds trust, data depth, and 24/7 responsiveness. When customers accept advice from a bot and act on it, the bank gains permission to automate more. The seed of delegation is planted, from answering to deciding. Level 2. Predictive market analysis, seeing what humans miss. Once institutions collect vast conversational and transactional data, they feed it into predictive engines. At level 2, AI ingests millions of daily signals, tweets, satellite imagery, shipping manifests, weather models, corporate filings, and spots correlations impossible for human teams. Firms like Bloomberg and JP Morgan run systems that process tens of millions of data points each day, producing signals that anticipate price moves, credit stress, or consumer demand. This isn't just faster forecasting, it's pattern discovery at scale. Imagine an AI that senses a drop in factory parking lot occupancy in East Asia and correlates it instantly with a supplier disruption in Europe, then warns traders and procurement officers before shipping manifest update. That lead time is worth billions. Why it matters? Predictive analysis changes finance from reactive to preemptive. Portfolios, credit decisions, and liquidity management can be tuned in near real time. The advantage accrues to those with the best data pipelines and the sharpest models. Level 3. Algorithmic trading. Markets run at machine speed. At level 3, AI stops advising and starts acting. Algorithmic trading is already the dominant force on global exchanges. Estimates put algorithmic and high-frequency strategies at well over 70% of equity volume in many markets. These systems execute trades in microseconds, exploiting tiny price differences, internalizing news instantly, and arbitraging across venues before humans can blink. The mechanics are cold precision, latency arbitrage, statistical arbitrage, liquidity provision at machine speed. Some firms co-locate servers physically adjacent to exchange matching engines to shave microseconds off the round trip. The result is a market that rewards algorithmic edge and punishes hesitancy. Why it matters? When AI drives the bulk of market flow, human oversight becomes supervisory, not operational. Liquidity can be deep, until it's not. Flash crashes and liquidity vacuums reveal the downside. Speed can cascade into systemic instability if models synchronize in the wrong direction. Level 4. Personalized banking. One bank, a billion tailored plans. Level 4 brings AI into the most intimate financial relationship, your money management. Personalized banking means your bank learns your cash rhythm, goals, and risk profile well enough to act as a bespoke advisor for millions simultaneously. This is no longer the preserve of wealthy clients who could afford a private banker. AI democratizes bespoke advice. Picture a system that detects a pattern. Your energy bills spike every November. You habitually delay retirement contributions in months with high spending, and you respond well to conservative advice during market sell-offs. The AI automatically rebalances your portfolio, pauses discretionary subscriptions, and alerts you with a suggested microloan if your cash runway tightens. Why it matters. Personalization increases customer lifetime value and embeds institutions deeper into daily financial choices. Products cross-sell seamlessly. Behavioral economics becomes actionable. Nudges, gamified savings, dynamic loan offers tailored by predicted stress events. Level 5. AI-powered fraud. Prevention, detecting the invisible heist. At level 5, AI becomes the security guard that never sleeps. Fraud detection moves from rules, if X, then block, to probabilistic reasoning across networks. Modern systems analyze behavioral biometrics, device fingerprints, geo-anomalies, and transaction graphs to flag, and often block, malicious activity before money leaves an account. This isn't theoretical. Enterprises report major drops in fraud losses after deploying real-time ML ensembles. Companies like MasterCard use AI capable of detecting suspicious transactions in under a second, combining location, merchant history, and typing or touch patterns. The system learns attackers' tactics and rewrites detection postures continuously. Why it matters. Secure systems build public trust, critical when you push automation deeper. Fraud prevention is both a shield and an enabler. The safer customers feel, the more they'll hand over control to AI. But it's an arms race. Attackers develop synthetic identities and adversarial methods that try to fool models, so defenders must keep iterating. Level 6. Virtual financial advisors. Automated life planning at scale. At level 6, AI moves from tactical nudges to comprehensive life planning. These aren't basic robo-advisors rebalancing a 60-40 portfolio. They are virtual financial advisors that model your entire financial life. They ingest income streams, debt schedules, tax rules, family plans, and even behavioral tendencies, then simulate thousands of futures to recommend optimal strategies. Imagine an AI that runs Monte Carlo scenarios for your retirement, optimizes tax loss harvesting across multiple accounts, times asset sales to minimize tax brackets, and even suggests timing for career moves based on projected local job market data. These systems can recommend when to refinance, how to restructure debt, and what to invest in to meet a child's college timeline, all personalized and continuously updated. Why it matters. This democratizes elite financial planning. People who couldn't afford a human CFP, Certified Financial Planner, now get hyper-personalized advice. But with democratization comes dependency. Entire households may delegate life-changing decisions to black box systems. That raises questions of liability, explainability, and who benefits when the advisor also sells financial products. Level 7. Smart cryptocurrencies. Money that thinks. Level 7 introduces smart cryptocurrencies, tokens embedded with AI logic that autonomously manage supply, liquidity, and contracts. These are not static ledgers. They are programmable money that can react to macro signals, execute complex agreements, and even govern themselves. Picture a digital currency that detects falling demand and reduces circulating supply to stabilize purchasing power, or one that automatically routes fees to ensure liquidity pools during stress. Imagine cross-chain agents negotiating swap terms with minimal human oversight. In decentralized finance, DeFi, combining on-chain governance with AI oracles could create assets that rebalance, hedge, and adapt in real time. Level 8. AI in financial regulation, guardians or gatekeepers. At level 8, regulators harness AI to monitor systemic risk, detect market manipulation, and surveil cross-border flows in near real time. The potential upside is enormous. Automated detection of laundering rings, quicker identification of contagion pathways, and regulation tuned to actual market microstructure rather than periodic reports. Level 9. Autonomous markets. When markets self-govern. Level 9 is where markets themselves become autonomous, trading venues that design and adjust their rules with minimal human input. These markets can create new instruments, tweak tick sizes, alter margin requirements, and shift settlement windows in response to stress signals, all governed by AI protocols. Level 10. AI-managed economy. Delegating the levers of society. At this level, AI ingests real-time consumption data, trade flows, labor statistics, and environmental inputs to optimize economic outcomes. Inflation targets, unemployment, carbon constraints, even distributional priorities. If this deep dive excited you, subscribe to EconoFix. Explained for the next breakdown. We'll map real-world policies and design choices that can keep AI's benefits while guarding against concentration and catastrophic failure.